You think you're diversified. You're not. If you own VOO, SPY, or any S&P 500 index fund, and most self-directed investors do, you have quietly, without anyone telling you, concentrated more than 35% of your entire investment into 10 companies. Most finance channels will tell you index funds are the safest, smartest, most diversified investment you can make. That was true. It is less true today than at any point in the last 50 years. When I ran the actual concentration numbers on a client's diversified index portfolio last year, he had more exposure to NVIDIA alone than to the entire energy, utilities, and materials sectors combined. There are tools already replacing broken passive investing, and the investors adopting them now are building a structural advantage that compounds. Stay with me, because what I'm about to show you changes everything. By the way, if you're new here, my name is Alex Carter. I've been working in personal finance for 8 years. In these 8 years, I've helped hundreds of people solve real money problems. And honestly, some of those people's lives completely changed because of it. On this channel, I help everyday people invest more intelligently than the conventional wisdom allows, with real tools, real numbers, and zero sugarcoating. All right, let's get into it. My situation about 3 years ago was a client review that genuinely unsettled me. He was 44, earned $115,000 a year, had been investing consistently for 12 years into a standard S&P 500 index fund, and considered himself a sophisticated, passive investor. He was proud of his discipline, and by most measures, he should have been. When I pulled up his actual holdings, not the fund name, the underlying positions, he had $340,000 in that fund. And approximately $119,000 of it, 35% of it, was concentrated in 10 companies. The other 490 companies in the S&P 500 shared the remaining 65%. He looked at me and said, "But I thought index funds were diversification." And they were. That's the problem. They were. Okay? Let me explain exactly what changed, because the S&P 500 didn't always look like this, and understanding how it got here is the key to understanding why it matters now. The S&P 500 is a market cap-weighted index. That means the bigger a company gets, the larger its share of the index becomes, automatically. When you invest $1,000 in an S&P 500 fund, your money is not split equally across 500 companies. It's allocated proportionally to each company's total market value. In 1990, the top 10 companies in the S&P 500 represented approximately 20% of the total index weight. That was already concentrated, but it was manageable. By 2000, the peak of the dot-com bubble, the top 10 had grown to approximately 27% of the index. And we all know what happened immediately after that. Today, the top 10 companies in the S&P 500 represent approximately 35% of the total index weight. That is the highest concentration in the history of the index. Higher than the dot-com peak, higher than any point in the last 50 years. And here's the thing nobody tells you. Every dollar you add to your S&P 500 fund automatically makes that concentration worse. Short pause. Because market cap weighting means the more money flows into passive index funds, and approximately $1 trillion flowed into passive equity funds in 2023 alone. The more of that money gets allocated to the already largest companies. The biggest get bigger. The concentration increases, not because anyone chose it, because that's how the math of market cap weighting works. Okay? Keep watching. Because what comes next is the historical precedent that shows exactly how this ends. Here's where it gets interesting and uncomfortable. The last time U.S. equity markets showed concentration of this magnitude was the early 1970s, with what became known as the Nifty 50. Short pause. 50 large-cap growth stocks, IBM, Xerox, Polaroid, Avon products, were considered so dominant, so obviously the future of the economy, that investors piled in regardless of valuation. Short pause. These were called one-decision stocks. Buy them and never sell because they could only go up. Short pause. Between 1973 and 1974, the Nifty 50 lost approximately 50% to 90% of their peak valuations. Short pause. Not all of them recovered. Polaroid went bankrupt. Xerox became largely irrelevant. The one decision turned out to be the wrong one for investors who bought at peak concentration. Short pause. I'm not saying Apple or Microsoft or Xerox. I'm saying that when 35% of the most widely held investment vehicle on Earth is concentrated in 10 companies, regardless of how good those companies are, the downside risk is not priced into most investors' assumptions. Short pause. Most finance channels only cover the upside case for index funds. That's not the full picture. The downside case has a historical template, and it's worth understanding before you need to. Okay? Stick with me. This next part is where everything changes. Because now I want to show you what's actually replacing broken passive investing, direct indexing. Short pause. Most investors have never heard of this. That's about to change. And the investors who understand it now are building a structural advantage over everyone who figures it out 2 years from now. Short pause. Direct indexing is exactly what it sounds like. Instead of buying a fund that owns all 500 stocks in the S&P 500, you directly own all 500 individual stocks yourself. Short pause. Your brokerage holds each position separately in your name. Short pause. On the surface, that sounds the same. The difference is what you can do with individual positions that you can never do inside a fund. Short pause. Tax loss harvesting. Short pause. When any individual stock in your direct index portfolio declines below your purchase price, your account automatically sells that position, crystallizes the loss for tax purposes, and immediately buys a comparable stock that maintains your overall index exposure. Short pause. You capture the tax loss. You stay fully invested. Short pause. Studies from Vanguard, Parametric, and BlackRock have estimated that systematic tax loss harvesting in a direct indexing portfolio can add approximately 1% to 2% of after-tax return annually. Short pause. That doesn't sound dramatic until you compound it. Short pause. On a $500,000 portfolio, 1.5% in additional after-tax returns compounded over 20 years is approximately $340,000 in additional wealth, from a tax optimization that a standard index fund structurally cannot provide. Short pause. But the second advantage is where direct indexing actually solves the concentration problem. Short pause. Because you own each stock individually, you can exclude or underweight specific positions. Short pause. You can tell your direct index account, I want broad market exposure, but reduce my allocation to the top 10 holdings by 50% and redistribute that weight to the next 100 companies. Short pause. Instantly, you've solved the concentration problem without leaving the index framework. Short pause. You can also exclude specific companies for any reason. ESG concerns, sector overexposure you already have through employer stock, or specific risk factors you don't want more of. Short pause. A standard index fund cannot do any of this. You own whatever the index owns, in whatever proportion the market cap weighting assigns. Short pause. Direct indexing gives you the tax efficiency and broad exposure of an index fund with the customization of individual stock ownership, okay? So you're probably wondering, what's the catch? Short pause. Until recently, direct indexing required a minimum investment of approximately $250,000 to $500,000, which is why it was exclusively available to high net worth investors and institutions. Short pause. That threshold has been dropping rapidly. Short pause. Fidelity now offers a direct indexing product, Fidelity Managed FID-Folios, with a minimum of $5,000. Short pause. Schwab's direct indexing minimum is $100,000. Short pause. Wealthfront offers a version called direct indexing starting at $100,000. Short pause. And the trajectory is clear. Within the next 3 to 5 years, direct indexing at scale will likely be accessible to anyone with $25,000 or more to invest. Short pause. The investors getting familiar with it now are positioning ahead of the mainstream adoption curve, okay? This is the part most people completely miss, because there's a second solution to the concentration problem that doesn't require direct indexing at all, and it's available to anyone right now. Short pause. Factor ETFs. Short pause. Factor investing, sometimes called smart beta, is the practice of tilting your equity exposure towards stocks that share characteristics historically associated with above-average returns over full market cycles. Short pause. The four most researched and evidence-backed factors are value, momentum, quality, and low volatility. Short pause. Value factor. ETFs overweight stocks trading at low prices relative to their earnings, book value, or cash flow, tilting away from the overvalued mega-cap tech concentration and toward companies with more reasonable valuations. Short pause. Momentum factor. ETFs overweight stocks that have shown strong recent price performance, systematically capturing the tendency of winning stocks to continue winning in the intermediate term. Short pause. Quality factor. ETFs overweight companies with strong balance sheets, high return on equity, and stable earnings, the kind of businesses that hold their value better during market downturns. Short pause. Low volatility factor. ETFs overweight stocks with historically smoother price movements, which counterintuitively have outperformed high volatility stocks over long periods, the so-called low volatility anomaly, documented in academic research since the 1970s. Short pause. The S&P 500 Value ETF from Vanguard, ticker VOOV, gives you broad market exposure with a deliberate tilt away from the mega-cap tech concentration. Short pause. iShares MSCI USA, Quality Factor ETF, ticker QUAL, gives you exposure to the quality factor with broad diversification. Short pause. These are tools available through any standard brokerage account, with expense ratios ranging from 0.10% to 0.25%, still dramatically lower than actively managed funds. Okay? You have agency, more than you're willing to accept right now. Short pause. Here's your portfolio audit in 3 steps. Short pause. Step 1. Pull up your largest index fund holding and look at the actual top 10 positions and their combined weight. Short pause. Most brokerage platforms show this in the fund detail page. If your top 10 holdings exceed 30% of the fund, you have meaningful concentration risk you may not have consented to. Short pause. Step 2. Decide which solution fits your current portfolio size. Short pause. If you're below $50,000 in investable assets, factor ETFs are the right tool right now. Accessible, low cost, and immediately diversifying away from mega-cap concentration. Short pause. If you're above $100,000, direct indexing is worth evaluating seriously. The tax loss harvesting benefit alone at that scale can be material. Short pause. Step 3. Don't make a dramatic portfolio shift in a taxable account without understanding the tax consequences. Short pause. Moving from a standard S&P 500 fund to a direct index or factor-tilted approach should be done gradually, adding new contributions to the new structure first, then evaluating whether and when to convert existing positions. Short pause. A 1-hour conversation with a fee-only financial advisor before making this move is worth it. Not to hold your hand. To make sure you don't accidentally trigger $40,000 in capital gains on the way to solving a concentration problem, okay? All right, so today we covered why the S&P 500's 35% concentration in 10 stocks has broken the original promise of index fund diversification, the historical precedent that shows what happens when concentration peaks, and the 2 tools, direct indexing and factor ETFs, that sophisticated investors are already using to build a smarter, passive portfolio. Short pause. If this helped you even a little bit, hit that like button. It genuinely helps this channel reach more people who need this kind of content. Short pause. Subscribe to the channel and make sure you hit the bell icon so you never miss a video like this. We drop new finance content every week, and trust me, you don't want to miss what's coming next. Short pause. And if you want to go even deeper on factor ETFs, which specific funds to consider, how to combine them, and what the long-term performance data actually shows, I've linked a video right here. Go check that out next. I'll see you there. Have a prosperous day.